You know that feeling when you buy something and the price drops the very next day? Now imagine that feeling, but it's your entire investment portfolio. You bought Bitcoin near the highs, institutions arrived, ETFs launched. Everything that was supposed to push prices higher already happened. So here's the question no one is answering clearly. Why isn't Bitcoin at $150,000 or $200,000 already? Today, I'm going to show you one financial structure most investors ignore that explains why prices can stall or even fall, even when the long-term case looks stronger than ever. This isn't a conspiracy. It's not manipulation. It's how modern finance actually works. And if you own Bitcoin, this matters more than you think. Why this video exists. I almost didn't make this video. Anytime people talk about banks controlling Bitcoin, the conversation usually slides into speculation with no evidence. But after digging into how financial pressure works legally, I realized something important. You don't need manipulation to push asset prices lower. You only need the right structure and the right incentives. History shows this again and again, with countries, companies, and entire markets. The simple model that explains everything. Let's start small. Imagine you own a $500,000 house. You take out a $100,000 loan with a variable interest rate. At first, the payments are easy, then interest rates rise. Your monthly payment doubles, but your income doesn't. Nothing illegal happened. No rules were broken, but suddenly you're under pressure. Your options shrink fast. Sell the asset, take on worse debt, or default. That's not manipulation. That's financial pressure created by structure. Now, scale that up. Now take that same dynamic and scale it to the institutional level. Instead of a house, imagine tens of billions of dollars in Bitcoin. Instead of a homeowner, a publicly traded company. Instead of a mortgage, convertible debt, and preferred shares. That company exists. It's called MicroStrategy. And understanding their structure explains why Bitcoin price action can feel disconnected from adoption headlines. What MicroStrategy really is. On paper, MicroStrategy is a software company. In reality, it functions like a leveraged Bitcoin holding vehicle. Here's the structure. They issue common stock. They issue convertible bonds. They issue preferred shares. They use that capital to buy Bitcoin. Today, they hold roughly 450,000 BTC. That's powerful, but it comes with obligations. Debt requires interest payments. Preferred shares require dividends, no skipping allowed. And here's the key detail. Their operating business does not generate enough cash to fully cover those payments on its own. So they rely on cash reserves or raising new capital. This is where pressure can begin. Where the real risk lives. MicroStrategy's stock trades relative to net asset value, NAV. When the stock trades above NAV, they can issue shares, raise capital, buy more Bitcoin. The cycle works, but if the stock trades below NAV, issuing shares becomes destructive, cash reserves start shrinking, and time suddenly matters. They currently have less than 2 years of cushion before difficult decisions appear. That doesn't mean failure is inevitable, it means pressure exists. And markets price pressure early, long before headlines catch up. Why institutions pay attention. Here's where incentives matter. Large institutions want Bitcoin exposure, but they care deeply about entry price. If a large holder ever needs to sell, it won't happen on an exchange. It happens through block trades, at negotiated discounts. That's normal market behavior. No secret meetings, no backroom deals, just math. This has happened before we've seen similar dynamics play out historically. In the early 2000s, certain financing structures created situations where lenders benefited when stock prices fell. The SEC studied these deals. Many companies collapsed legally. Not because their assets were worthless, but because structure applied pressure at the worst possible time. MicroStrategy is not the same situation, but the lesson is timeless. Structure matters just as much as fundamentals. What this means for Bitcoin holders. This does not mean Bitcoin is broken. It means Bitcoin is not the same as companies holding Bitcoin. Volatility is not failure. Pressure is not manipulation. In fact, pressure often appears right before accumulation. Retail investors ask, why is the price down? Professional investors ask, what structure is creating this move? How to use this information. Here's how this actually helps you. First, don't confuse short-term pressure with long-term failure. Second, watch structure, not headlines. Debt timelines, cash reserves, refinancing windows matter. Third, if you believe in Bitcoin's long-term thesis, volatility isn't a threat, it's part of the process. And most importantly, education beats emotion every time. I'm not here to promise price targets. Markets don't work that way. What I can show you is how financial pressure works legally and why understanding it gives you an edge most people never develop. Assets don't move randomly. They move where incentives push them. If this helped you see the market more clearly, subscribe. This channel is about thinking rationally when markets aren't. And let me know in the comments, do you think this pressure is temporary or structural? Either way, stay curious. Because in finance, the real edge isn't prediction. It's understanding the rules before everyone else realizes they matter.